Ladies and gentlemen, we are witnessing one of the biggest de-dollarization programs in history. We also have inflation that is getting out of control, the US dollar losing more purchasing power than ever before, and also behind the scenes, the Fed versus the Treasury, and ladies and gentlemen, all roads lead to inflation. So it's time to buckle up. Pay attention, because your valuable money in the bank, your valuable dollars, also other countries around the world like the Australian dollar, the euro, are losing value at record pace, and you need to know how to prepare for what's coming. So ladies and gentlemen, this is going to be a very, very important video. I've got lots to cover, so let's not waste any time. Let's get straight into the news, the facts, and the data. So first things first, what I want to cover, everyone, is this. What people don't realize is happening. There is a Ponzi scheme, and this is the Federal Reserve versus the US Treasury Department. And unlike what they're trying to say, inflation is not going down and it's going to get worse. And I'll grow into the BRICS story with Asia and de-dollarization in a moment, but this is very, very important. You can see the tug of war. We are going nowhere, and let me unveil how this Ponzi is working. So the Federal Reserve raises interest rates to make loans less attractive and bring inflation down. But the Treasury has its own set of magic tricks to artificially stimulate or tighten the economy as well. And guess what, people? It won't lead to something good. One of them is a Treasury buyback program, something that was just reincarnated for the first time in about 2 decades. That's right, you might find this a bit funny, but this is, again, how the Ponzi scheme works. This is where the Treasury repurchases its own outstanding securities from the open market to increase liquidity, stroke demand, and bring down yields. This would be like you buying back your own mortgage to try to keep your mortgage rate down. If the Treasury markets can't be reined in, the Fed expands its balance sheet by buying those Treasury securities to add liquidity and stability. So again, if it wasn't for the US government and the Federal Reserve buying these bonds, we would see interest rates go up out of control, because China and the rest of the world is dumping US debt, dumping US bonds. These open market operations are usually the money printing that people are talking about happening at the Fed. QE, they call it. That refers to quantitative easing, to its operations where the Fed is buying other assets beyond just Treasury securities, as occurred in the 2008 crisis and during COVID. But the Treasury buying back its own issued debt is in the essence QE by another name. So the Treasury issues more short-term debt and is waging war on the Fed's high interest rate policy. Both the Treasury and the Fed need to keep yields down, but tight monetary policy encourages higher yields. That's right. So the government doesn't want, interest rates to be high, because the US government is broke. It's in $34 trillion of debt, and its interest payments are over $1 trillion a year. But the Federal Reserve is trying to bring down inflation, but I think we're going to hit a stalemate. The bond market and challenge industries like commercial real estate rely on debt, and they are screwed. So while the Fed tightens, the Treasury loosens, and yields have since gone down, but if inflationary pressures and other factors push them back past 5%, both the Fed and the Treasury are tapped. That's exactly right, everyone. This Ponzi scheme cannot keep on going on forever. Eventually, the natural laws of economic supply and demand will play out. And they're just trying to bite their time, but things, I think, are getting very, very close to imploding. And again, like I was talking about in the start of the video, a massive event just took place. Look at this. This is going to shock you, everyone. So I'll go ahead and adjust this here. So Sean, so this is Asian nations to increase local currency, reducing reliance on the US dollar. We've seen huge sanctions put on countries that go against the US and the Europeans regime, and they're being punished. And this has actually backfired, because now the rest of the world is panic selling US dollars, is panic selling US treasuries, and we're seeing the end of globalization. So at the 42nd ASEAN Summit held in Labuan Bajo, Indonesia, ASEAN members signed an agreement to push for better regional payment connectivity and use of local currency transactions, and the move is seen as the bloc's strategy to transition away from established currency used for trade such as the US dollar. But it goes even further than that, everyone. So ASEAN is wary of the impacts of sanctions. So members who are also aware of the role the US dollar plays in sanctions brought on by the US along with the EU froze some 300 billion of Russia's foreign reserves and cut its major banks from accessing the SWIFT network in a bid to cripple the Russian economy. As such, these sanctions have forced countries to mitigate their risk and engage in diversifying their reserve currencies. Further, they are also wary that the US could use the power of its currency to target them in future. So again, this tool of sanctions has backfired and backfired big. Let's keep reading, everyone. China has been getting rid of its US Treasury bonds, like I was talking about. They hold 870 billion in US debt, and this is the lowest since 2010. But they could still dump this at any time and send US Treasury interest rates for these bonds skyrocketing. Iraq has now allowed trade with China to be settled with the yuan, and China and Saudi Arabia are also considering some pricing of oil sales in yuan. And we all know that wouldn't go down very well with the US. The central banks of Indonesia and South Korea have agreed to expand the use of each other's local currency for bilateral transactions, in addition to India and the UAE also finalizing a deal to trade in their currency. So people, we are watching the slow death of the US dollar actually accelerate. And the BRICS nations, Brazil, Russia, India, China, South Africa, they're accelerating as well. Look at this next report. So the BRICS pushing for common currency in bid to reduce reliance on the US dollar, South Africa says. So let's dig a bit deeper into this report. The BRICS are advancing the progress of its common currency while actively promoting the use of local currencies from member states to reduce the risk of solely relying on the US dollar. Now, he also stressed the importance of supplying the use of local currencies with open financial data sharing while looking into digital currencies as ways to explore multiple and stable mechanisms for trade and settlement to reduce the risks such as sanctions by just solely relying on a single currency. So you may see BRICS. We all know there's lots of rumors that they're going to try to create their own currency that may be backed by gold or other commodities. When it comes to BRICS expansion, he highlighted the fruitful achievements realized during the BRICS summit in 2023. So for those who don't know, BRICS is accelerating rapidly, which held in Johannesburg, South Africa. BRICS leaders agreed at the summit to invite 6 countries, including Egypt, Ethiopia, Iran, Saudi Arabia, and United Emirates to join the group. But that's not all. He also noted over 20 countries had expressed interest in joining the group as they saw the positive aspects of being a BRICS member, adding that the new members also represent significant economies across the world. So people, what we are witnessing is a massive shift in the global superpowers. We're seeing the West lose power, the East are rising, they're diversifying away from the US and the West, they're building their own currencies. And when you look back at history, what the US is doing is like what the great Roman Empire did. They are diluting their currency, they're destroying their country, they're spending trillions of dollars on wars around the world that they cannot afford. They are losing and depleting military supplies, and it's only a matter of time before the great US empire falls. And countries know this, they see this coming, and so they're diversifying. And we should do that too. If you have all your money in US dollars, you're going to want to get some commodities like gold, silver. And I also want to talk about today's video sponsor. This is the end of the news segment, and I want to talk about today's video sponsor, Iberamerican. That's stock ticker symbol IBRLF. Because like I was talking about, the US dollar's days are numbered, and we're seeing commodities go up through the roof that are priced in dollars. So let me talk about an opportunity in a commodity that I believe holds incredible potential. And if you're curious about tin and why it might be worth your attention, stick around because this could be a game changer. Tin prices have been on a tear lately, and I bring up a chart here. Surging higher due to supply disruptions, the London Metal Exchange recently saw tin prices reach a whopping 30,000 per ton. So this spike in prices is largely because the supply chain for tin is under significant stress and is only going to get worse. And that's why I want to talk about, again, today's video sponsor, Iberamerican. They're on the brink of acquiring Europe's largest tin mine, the Penalta project in Spain. This mine used to produce tin at record levels, and Iberoamerican's goal is to get it back into production. So what's fascinating about Iberoamerican is its leadership. The former head of commodity research, Carlyle Group, one of the biggest private equity firms in the world, is now director at Iberoamerican. His name is David T. Young, and he managed $4 billion in commodities at Carlyle. He didn't join Iberoamerican for no reason. He sees something big here, and I do too. One of the key things to note is there's no tin ETF whatsoever. Most of the world tin comes from regions with high risks like Africa and Asia. This makes Iberoamerican's position even more unique. They're about to own the largest tin mine in Europe, which is a much more stable jurisdiction. Now, listen to this. Iberoamerican is valued at just around 22 million US, but that's for now. But the Penalta mine, which when it was in production, had a market cap of 78 million. That's a significant difference and shows potential for growth once they get the mine up and running again. Why is tin so important, you may ask? Well, over 50% of the world's tin is used as an electronic solder for joining circuit boards. With the rise of electronic vehicles, AI, 5G, and more, the demand for semiconductors and therefore tin is only going to increase. The global semiconductor market is projected to double by 2028, making tin even more crucial. Now, the CEO of Iberoamerican, Campbell Boettcher, is determined to increase revenues by improving quality and accelerating production. He has brought in engineering experts to build a plan for efficiency. This strong leadership team is a major plus for the company. Now, another thing to consider is a global supply chain for tin. The largest producers are China and Indonesia, but these aren't the most reliable sources for Western countries, especially after we just spoke about. The geopolitical risk in these regions can impact the supply chain. Having a major tin mine in Europe could be a strategic advantage. So to wrap things up and put it very simply, the demand for tin is surging, and Iberoamerican, again that's ticket symbol IBRLF, is in a prime position to capitalize on this. With the acquisition of the Penalta mine, experienced leadership, and a growing need for tin and technology, they have a lot of potential to start doing your own research today. So everyone, again, you definitely want to diversify your portfolio, get out of the US dollar because it's only going to lose more purchasing power. But what do all of you think about this? Let me know down below. You're awesome. I'll see you all in the next video.